Alrighty, you are listening to KPCA LP, Petaluma, California, 103.3 FM. You can also catch us online at kpca.fm. And if you want to email, you can find us at kpca@pca.tv. And if you want to send snail mail, you can get us at P.O. Box 2806. Petaluma, of course, California, 94953. So you are here with DG the 30-something for the State of the Union show. And I am taking on a huge beast today and talking about tax reform. So I want to start by talking about the process. And I'm not doing this to be condescending. I just want to say that out from the gate. But I also feel like a lot of people don't understand how our legislative process works. And I think that that's exemplified by how media has predicted this tax reform and also just by what people are posting online and on social media and talking about like decisions have been made and this is it and that's everything. So I just wanted to start by showing the process. And it's so funny because all day I've spent hours researching this. Like, this is a very hard topic. I've spent hours researching. I've talked to accountants and experts in order to kind of help myself understand this, because I am not an accountant. I'm not a legislator. I'm not a lawyer. And so this is a very complicated issue. And I don't like to see it being simplified in the way it has in the media. So it's not to say that it shouldn't be distilled down, but I also don't want it simplified. And so I wanted to start with how the process works. So as everyone has seen, the bill, it's called the Tax Cuts and Jobs Act, which is so funny because they always give these really kitschy names, catchy names to these bills, even though they don't necessarily address any of those issues, to be honest. But anyway, so the bill was passed recently by the Senate in a very narrow margin. So it was passed 51 to 49 votes. Again, that's a very narrow margin. That's not at all a landslide. And then the House passed it prior. So I'm kind of going backwards. The House passed the bill with a 227 to 205 vote. So that's still a pretty slim margin. We're not talking about a huge margin. And so what I want people to understand, because I've seen a lot on social media, I'm big on social media, I think we all know that, is that people are posting stuff that basically say, like, this is the end of this is the end of that. But how this works is that the Senate and the House bills are actually very different. In order for something to become in law, they have to agree. So right now, the Senate and House are in committee trying to agree upon a bill, because unless it's agreed upon, it cannot go to the president for the final signature. And even once that happens, even if the Senate and House agree, the president can still veto it, and it basically starts from the beginning. And so, like I said, I've had the Schoolhouse Rock, I'm Just a Bill song stuck in my head all day, because it goes through how long and laborious the process is. It's not a matter of the House passed it, the Senate passed it, now we're losing all these things. And I think that's a really important thing to understand, is that nothing's finalized yet. We actually don't know what's going to happen yet. There are some agreements that might be imminent. A lot of the analysis of the two bills is that perhaps the House will just pass the Senate bill. The problem with that is that the idea is that it'll bitter a lot of the House Republicans. And because, like I said, there's some very vast differences in the two bills that were passed by the two bodies. And originally, the Republicans had hoped that this bill would be settled and before the president, before Christmas, before recess, which that's not going to happen. There's no way that's going to happen because the two bodies have to come to agreement, and I can't imagine that would ever occur before the holiday season happens. So I want to start by talking about the tax bracket. So and I actually had to bring my computer in this time because it was so complicated that I had to bring up spreadsheets and comparisons. Like I said, I talked to some experts about this because, again, I'm not I'm not an expert in these things. And so that was a big part of my research is talking to accountants and other people that'll be affected by this bill, business owners, and all that kind of stuff. So just in case you were wondering what it takes for me to prep for my show, it takes a lot. But my goal is always to help hash out the issues that are going to affect the most people, because I think that we get caught up in the extremes of what's going on, but then we forget that there's actually a lot of, I've been calling them all this time, microaggressions that the government is doing, and they're incorporating into these bills that is different. So I want to start about talking about the tax bracket. So they're not exactly the same in both the bills, but they're pretty close. So I wasn't going to stress about the minor differences between the two bills and the tax brackets, but I wanted to talk about the differences in income between 2017. So this legislation will not go into effect in 2017. I've heard that over and over, that people just think it's going to be immediate and imminent. That's not how government policy works. It's not going to be right away. They are trying to predict that after December 31st, 2017, that this new legislation will go through, whatever it looks like. But again, my personal projections is that that's not really going to occur. There's no way that's going to occur that fast. Government doesn't work that fast. So, like I said, there are minor differences. So, for example, the House version of the bill that they passed calls for a 12% taxation below $45,000 a year, where the Senate version calls for a 10% tax rate under $9,525 a year. So I am going to do the calculations based on the Senate version. That doesn't mean that that's going to be the answer, but I also feel that it will give a good indication of where things are going, especially in the higher tax brackets. We're talking about, if you make over $500,000, we're talking about a 39.6% taxation in the House version and a 38.5% in the Senate. So we're not talking about huge differences. But in the House version, the breakdown is way more broad, where in the Senate version, they have way more tax bracket breakdowns, which we're used to. If you've ever looked at the tax brackets, we're used to a breakdown over, I think it's 1, 2, 3, 4, 5, 6. It's 7 different categories, where the House version kind of whittled it down, which doesn't really make sense. However, so I did some calculations to help understand this. So, so again, this is based on the Senate bill that was passed. And again, I'm using the Senate bill because a lot of the predictions expect that the Senate bill is what's going to be adopted. Again, we don't really know what's going to happen at this point. And so I'll get to this in my analysis, but I really want people to stray away from saying that there's a lot of this doomsday predictions, like, oh, this is gone, this is gone, this is gone. This isn't a law yet. This is not a law. So we actually don't know yet what is going to happen. And that is a really important thing that I really, really, really want to stress, is because a lot of the media I've seen around it is that this is happening, everything's being cut, everything. So there are certain things that perhaps by normal deduction that we think are going to happen based on the current leadership. But I also think it's really important to remember the process of our legislature and how it works, that they have to come to agreement. It has to go to the president, and technically the president can still veto it. I don't think he will, just because it is a Republican-dominated Congress at this time. And so I don't think he's really going to go against it. However, there might be some provisions that he doesn't agree with. So the tax amount for 2017, if you made $90,000, which is not the average American, but I wanted to start there because I think it gives good context. So in 2017, the taxes due would have been $18,239. And in 2018, it is being amended that you'd owe $11,679. So again, this isn't accounting for all individualized deductions. This is solely based on the tax brackets and the taxes that would be due on a raw level. So the tax amount for 2017 for someone that makes $19,000, so $19,050 is $2,391, and then the tax amount in 2018 would be $1,905. They're changing it to a 10% tax bracket. And again, I'll get into my analysis of all that after I'm done with all this complication, because I think that there are some long-term effects of these laws, and a lot of the predictions show that to be true. So this is kind of the kicker. So what we would expect from this leadership is that they are trying to support the wealthy and the larger companies. Again, my show's nonpartisan, but that is what we would expect based on the leadership, and they've shown us that time and time again. So the tax amount in 2017 for someone that makes $1 million a year is, I think it's about 33%. It would be $348,329. The tax amount for 2018 would be $301,479. So that may not seem a lot, but it's about $48,000 in savings. And so you can see over the next 10 years, and there's a lot of provisions that change over the next 10 years that will show this indication, but you can see how over the next 10 years, because they've changed the inflation calculations. And I don't want to get into all the minutia because, quite frankly, I don't understand it, and so I don't want to get into that. But you can see by percentage how the wealthier population is saving a larger percent in their tax income based on these things. So now what I want to do is I want to go through the differences between the House and the Senate version. I just went through the tax brackets. Like I said, there aren't huge differences between the tax brackets. That's why I just focused on the Senate calculations to make it simple. So there are some pretty significant changes to the standard deduction. So people may or may not be familiar with this. I think a lot of people that don't have a lot of itemizations are familiar with the standard deduction. Myself, I usually fall into the standard deduction realm after I didn't become a sole proprietor, and we'll talk about pass-throughs. They're kind of hurting pass-throughs in the legislation, so we'll talk about that later. But so basically for a single person, the standard deduction is almost doubling. So they are increasing the standard deduction to about $12,000 for single people, and then $24,000 for joint filers. However, the really important part about this is that they're also getting rid of a lot of itemized deductions. So that'll be really important, especially for people that have large assets like companies, houses, and other assets. So they'll really be affected. So if you normally take the standard deduction at face value, it'll probably benefit you, but in the long run, it can hurt you because they are cutting a lot of the itemized deductions. So, the child and tax credit, family tax credit, this has been a big hot button issue that I've seen posted over and over. And the House and the Senate are not that different on it. So the main difference is that the House is giving you a $1,600 tax credit per child. However, the cap is at $230,000 joint filing to get that credit, where in the Senate, the phase out's at $500,000, and then you get $2,000 a child. But again, they've put caps on the timeline. So as of 2025, this will be phased out at this current legislation. So they're kind of setting a deadline. And some of these changes actually change as of 2019. So we'll get into that. Some of them are very short term. And I will get into the specifics of that later, because I think that's a really important thing to address, how some of these things are being phased out after a year, or some are being phased out after, 8 years. So the medical expense deduction, this is another one that was a huge button issue. The House wanted to completely repeal the out-of-pocket medical expense deduction. So traditionally, we saw that if you paid more than 10% in out-of-pocket medical expenses, that you could deduct that amount. and the House wanted to completely repeal that, so you couldn't at all deduct out-of-pocket medical expenses. And that's a really a kind of a broad definition as a personal person. So it actually can include insurance, or it can include coverage that's not included in insurance. So just as an example, when I was a sole proprietor, I would write off, I had to pay out of pocket for everything besides my medical insurance. So dental, chiropractic, any sort of thing like that. So I would use that write off because it would every year exceed 10% of my adjusted gross income. And that's kind of where the calculation comes from. And for most people, it would exceed 10% of their adjusted gross income. And so you could write off that amount. And so the House completely wanted to repeal that measure, which is a big deal. And again, I will get back to that. I think that coupled with some other provisions that they added is very significant. So the Senate, however, made an interesting change where just between 2017 and 2018, they actually decreased the percentage to 7.5 that you could write off. Again, this is adjusted gross income. And so it actually benefits, but only for 1 year. And again, we'll get to why that's significant later. We'll see how that affects people given the certain ACA requirements or, coverage right now. The out-of-pocket medical expenses are different than they were before. Especially for individuals that are employees, things are very different than they were before. So this is another one. So the mortgage interest deduction, the House wanted to limit the interest deduction to $500,000. That's kind of a large amount. Most people aren't really in that realm. And the Senate actually keeps the mortgage interest deduction. However, it eliminates the deduction for equity debt. Again, I don't own a house, but for people that do, that'll speak to them, because all of a sudden now they actually can't deduct their equity debt, which will be a big deal for a lot of people, especially in California, because housing is so expensive and a lot of people take equity out against their house. So you can no longer deduct that on your federal insurances. So this is graduate student income. It's so funny that they call it graduate student income when really it's loan income. And when I was school, I didn't think that my loans were income. It was accrued debt. So the House wanted to use the tuition waivers as taxable income. That would have been a huge, again, we don't know what's going to happen. That would be a huge hit on a lot of students, that all of a sudden, whether you're getting a tuition waiver or whatever, it would all of a sudden be taxable income. That's a really, really big deal, where before it was not taxable income. Luckily, it was not included in the Senate version. They didn't even actually touch it. I would think part of the reason is that they didn't think they could get it passed through Senate when they had such a narrow margin if that was included, because a lot of the Democratic Party wants to see student loan and tuition reform happen. So I think the Senate omitted it because they knew they couldn't get it passed if it was included. So this is getting a little bit into the specifics. If you're not a business owner, it won't affect you. But as a business owner, and I've been talking to a lot of business owners, and I talked to my accountant who's a business owner, and they are making some significant changes to pass-through entities. So we're talking about LLCs, and I have an S Corp, and so that's technically a pass-through agency. And I don't want to get into all of the specifics about it, but in general, what they're doing is that they are changing the caps, and they are making it more restrictive to have a pass-through agency. And I think it said that, so the cap so the cap for the pass-through is 25% taxation, then setting anti-abuse rules that begin with the rebuttal presumption that 70% of pass-through income is wage income, which would then be subject to the normal tax rates. And then the remaining 30% is subject to the lower rate, but it also excludes many professional service companies from the preferential rate. So this is a really interesting addition because, again, at face, it seems like it's going to be really beneficial for small companies, but how do you just exclude professional service companies? I have a professional service company, and so all of a sudden I'm being excluded from this beneficial tax rate, which I don't even think is that beneficial. So that was the House's passing. The Senate adopted a 23% deduction for pass-through income, but it's limited to 50% of wage income for qualifying businesses, including publicly traded partnerships, which are not, I'm not an expert at this, but publicly traded partnerships are not pass-throughs. They are generally C Corps. So, and then there's a longer list of ineligible service providers. So actually it is even more inhibiting than the Senate rule. So again, if you don't own a company, that probably isn't really affecting you, but it could potentially really affect people that have small companies. So of course, there was a corporate tax reduction rate. Again, no surprises. It mainly affects C Corps because a lot of S Corps are taxed as pass-throughs. They're taxed like LLCs. And they cut the taxation rate. This was across the House and the Senate. They cut the taxation rate from 35% to 20%. So corporations will now be paying less than a lot of the individual tax brackets, which is a important indication of where the leadership is at. I don't even think I'm going to get into capital investment. I think that's, again, I think that's kind of provision that affects a small amount of the population. I'm not going to get into the alternative minimum tax. It's a very complicated, convoluted calculation. In general, I was just talking to a business owner about this, and we generally agree that people should be able to do their own taxes. It shouldn't be this complicated. You shouldn't have to spend hours reading through the legislation in order to understand it. So a lot of tax professionals, I would think, want to just get rid of all these complications because individuals shouldn't have to be dealing with all this. So there's changes to the caps of interest deductions. That's across the board. Again, I don't want to get too much into that. I'm not going to talk about net operating losses. Again, that affects businesses, but they are changing the write-offs for net operating losses. The Senate actually eliminates it, which again will really affect a lot of businesses because a lot of businesses write off those net operating losses. So this is actually, again, significant. This is business related, but it changes the eligibility or the definition of a small business. So it says that in the House bill, they increased the small business eligibility from 5 million to 25 million. A lot of the definitions were based on employees, but they're actually talking about revenue. The Senate bill is 5 million to 15. This is why I call myself a micro business and not a small business, because if you have $25 million in revenue, you're not a small business, in my opinion. That's just not how it really works, but they are. And I have to say, so I'm on the leadership council for the National Business Association, and we talk about this regularly because there's a lot of incentives for small business, especially for federal contracts. They have special opportunities and protections under the law. And so by changing the eligibility as a small business, you're basically changing the pool for people that can apply for these contracts. Where before, in most funding sources and most contracts, small businesses were the contracting agency was required to put a certain percent of the the contracts towards small businesses. So they're changing what a small business looks like, which can be really detrimental. I'm someone that runs government contracts, and basically it is making it even harder for me to get some of these contracts because they're changing the definition of what a small business is. And as a side note, even before the tax bill, they are trying to deduct a lot of those requirements to contract with small businesses. And again, it's not shocking that they're trying to protect big business. Again, I'll get into that. I'm not shocked by that. This was the entire presidency election was based on protecting big business, not small business. So, and I go on a tangent, but I got into this debate quite a bit with people because they kept saying that this leadership was going to be good for business. And I had to say over and over and over again, it's good for big business. There's not going to be any benefit for small business. And we see that with the limitations with pass-through agencies, which are mainly small businesses, where there's a lot of protection for C Corps. And C Corps, I don't want to get into all the business structure. I would need Dan the lawyer here to help me, but C Corps tend to be much larger companies, and there is a very different structure, and they are not pass-through agencies. So again, there's a lot of protection for large companies. Most C Corps are very large companies, and not included in this comparison is that they changed how shareholder income is managed, which again, I know a lot of people are probably watching this and saying, well, that's not really going to affect my day-to-day, but it will actually really affect your day-to-day, because when you talk about products that you purchase or going out to places that are these large companies, it will eventually affect you, even if it doesn't affect you personally at this time. We know that eventually it will, and this is a product of trickle-down economics. They think that if they cut the taxes for the very top, that the supply and demand will make the individual products a lesser price, but we've shown through history that that's not how it works. So it'll be really interesting to see when you reduce corporate taxes. My prediction would be that it's not at all going to pass through to the consumer. It's going to benefit the shareholders. And a lot of the changes in that legislation points to that direction. We know trickle-down economics doesn't work, but they keep trying. Whether you want to call it trickle-down or Reaganomics, we know it doesn't work. So again, there's a lot about business restructuring, and I'm not going to get into, there's business credits and deductions. It very much limits. Both bills limit the deductions. Again, this is mainly going to affect small businesses as opposed to large. Let me skip past international income. Well, I think that it can be important because, again, this is affecting large companies that have, bank accounts and money internationally. It's providing, more protections, whatever you want to call it. It's changing the tax rate. So I want to jump to estate tax. This is actually a really interesting one. And again, a lot of people that don't have a lot of assets don't necessarily think about it. But so the estate tax, let me explain it because I think it's important to explain. So the estate tax is basically if a person passes away and they are transferring money, cash, or assets. So it could be your house, but really at the end, the estate tax addresses the cash value of those assets, stocks, bonds, whatever it might be. So the House increased the exemption. So what they're doing is that they're creating an exemption for the amount of money that is handed down. And I think that there's a really interesting rationale in why. So the tax rates were very high for estates. And I personally think the rationale in that is that there's a few things. I think that the rationale is that a lot of that money perhaps was not taxed prior because it wasn't necessarily straight income. And the other rationale is that I think that there's this idea that gifting money shouldn't be completely untaxable. I can't say that I necessarily agree with the very high rates that were prior, but I think this is a really interesting modification. So the House changed. So again, so they're changing the exemption rate. So this is the value up to the value of your assets where you're exempt from paying taxes on. So the House increased the exemption to 10 million. And then the Senate doubles the estate tax exemption to 11 million. So both of them are pretty close. But again, that's a doubling of the exemption. So again, this is really affecting the wealthy because I know that none of my family members are going to be leaving me $11 million. But it's showing that you can leave up to that much money and be exempt from the taxes. I wouldn't be surprised in the final version if they actually also decrease the tax amount without, not only increasing the exemption. Again, they are on a slippery slope because every single Democrat in the Senate voted against this tax reform. And so it'll be a really interesting process when the Senate and the House has to come together and come to some sort of agreement to pass this. So this last part, you have to bear with me. I've had a cold, so I'm trying to keep myself going radio voice. So basically the House, so the individual mandate. So the individual mandate is for ACA. I always stray away from calling it Obamacare because that's not what it's called. It's called the Affordable Care Act. And a lot of people don't realize that that's the same exact thing. So you won't ever hear me, besides this moment, call it Obamacare, even though in a lot of the media they did call it Obamacare. It's the Affordable Care Act. And the House made no change to the mandate, where the Senate actually striked the mandate. They made the penalty $0 if you don't have health insurance. The prediction is that because of that, millions of people will no longer have insurance. I am still curious to see what happens because what we've seen is that because the insurance agencies, who are completely unregulated to the most extent, so I have my qualms with major pharma and the insurance companies, is that in predicting what was going to happen in the coming years, they increased the rates by 33% on average per insurance per month, which is greatly detrimental. And if you aren't receiving a subsidy, that's a huge, like my insurance went up $100 a month. So that's a huge hit. That's not like a minor change. That's a very large change. So if we're talking about, a lot of the personal exemptions being cut, and then after 2018, we don't know if we're going to be able to maintain the out-of-pocket medical expense write-off because they've made it very wishy-washy. where they have reduced the rate for conceivably 2018. I want to make it very clear again, we don't really know what's going to happen. None of this is a law yet. It's just two bills that were passed by two houses. And again, you're just a lot of this is just about losing a lot of personal itemization deductions. So that will affect a lot of people. And it will potentially not affect other people. So another one that actually I haven't mentioned yet is the state and local income tax deduction. So they have both the Senate and the House repealed the deduction. However, it allows a $10,000 deduction for property taxes. And the biggest note about this is that bicoastally, that's going to affect us because we have a lot higher state and local income taxes. So they say that New York's going to get hit the worst because they have some of the highest state and local income taxes in the entire nation, but California is close behind. So this is going to be really interesting because prior, a lot of these were an itemized deduction, but if you are all of a sudden getting rid of the itemized deduction, it's going to really affect people. So, and I think we already went over mortgage interest, but yeah, the Senate repealed deduction on home equity loans. That's gonna, that's gonna hurt people. And then, this is actually one I want to talk about because I've seen so many articles and so many posts about the teacher supply deduction. The House bill actually removed it, but the Senate bill increased it from $250 to $500. And I don't agree with the base teacher supply deduction in general because you're talking about $250 to $500 in your entire annual deduction. Is that really going to exceed the standard deduction? Probably not for a lot of teachers because they're not making that high of an income and they don't have a lot of assets to deduct. So the Senate is trying to gloss it over by saying, oh, we're going to double the teacher supply deduction to $500. Well, what effect does that really have when you've also gotten rid of a lot of the itemized deductions? What effect is that really going to have? Like, why would a teacher potentially that makes between $45,000 and $75,000 a year, depending on how wealthy the area you live in? And again, I think it's all relative. Even if a teacher is starting at $75,000 a year, I think as in Marin County, the teacher starts $75,000 a year, but the livable wage in Marin County is six figures. So it's relative. So how is a $500 deduction really going to affect anything when you're getting rid of a lot of the other itemized deductions? So that is been something that the media has taken and run with, which I think is really interesting because when I look at it, and I think that teachers should get way more support than they do, but when I look at that, like, you're disputing a $500 deduction. Look at the facts. Look at the facts about this issue. And that's when I get into my analysis. People need to stop reading the headlines and need to start looking at the facts of how the issues work and advocate for what you really believe in. You shouldn't be sitting here saying, oh, the House removed the teacher supply deduction. You should be saying, why is the Senate only proposing a $500 teacher supply deduction? So those are two very different issues that need to be addressed. And I generally feel that, again, I always circle, I say this every time I have a show. I always circle back to the headlines in the media. They run away with things and they forget to address the major issues that are actually at stake. So we are going to talk, and actually the other one is, the other key point is everyone was talking about the elimination of student loan debt for public service. I have not been able to find anything in either legislation to that end yet. So, and again, I'm not an expert in this, but if anyone can find that, please point it out. I've seen a lot of articles about it. Again, it wouldn't shock me I know that they did get rid of the itemized deduction for interest rate on student loans, but I haven't seen anything yet about the actual forgiveness. Like I said, it wouldn't shock me if that was the case, because this legislation is not big on education. But I want to see the facts on that. So I read the legislation last night. I talked to my accountant. I talked to a lot of people. I haven't seen that yet. So someone show me the facts about that, and I will believe it. Even prior, when Obama was president, he developed a program for the future that expanded the public service forgiveness to a lot more fields. So I'm in public health, and prior I couldn't get any forgiveness after 10 years, where physicians, psychologists, psychiatrists, other fields could get a forgiveness for 10 years if they worked in public service, a public clinic. And as a public health professional, I couldn't get any forgiveness. And so when Obama was in office, he only pitched off this idea. So I saw the application so you could apply, but the actual legislation was not in place. So really it was applying for potentially what could happen in the future. So again, like, none of that's really permanent. That's why I joke, I'm just a bill on Capitol Hill. It was all just an idea that it might happen. I was very skeptical even in that instance, because they're basically saying, well, apply, and then potentially at some point you might qualify for forgiveness after 10 years, and it's retroactive. But I knew as soon as a new leadership was put in office that was going to be gone, because they do not, even the Democratic Party was not actually addressing students that were already in debt. They were only addressing students that might be in debt in the future. And that was one of my biggest pet peeves during the election, is that I'm someone that's already in debt, and I work in public service, and I really get no help. And I also understand that I made a decision to go to grad school, but I'll never forget, it was an attorney, actually, that looked at me and said, well, you fell subject to the same predatory loans that people, when they were buying their houses they couldn't afford, fell to too, because when you're 22 years old and you get into grad school and they basically just hand you money at a ridiculous interest rate. I think my federal loan was a 9% interest rate. My car's 2%. You just don't think about it. You don't think about it. You're just kind of like, okay, well, yeah, I want to go to grad school. I want to take this money. $75,000 later for a piece of paper where you have no chance of forgiveness. That's a hard pill to swallow. But, and again, everything's clear in retrospect. And a lot of students, whether it's undergrad or grad school, have fallen victim to this because they just don't realize. We don't realize. We think like, yes, we need to take this loan so I can go to school. I can better my career, I can better my education, but when you come out, you're like, oh shoot, I didn't really do anything. So that's my biggest pet peeve, cross-partisan, is that no one was actually addressing. Again, Obama pitched off this idea that at some point there would be this forgiveness, but it wasn't actually anything that was in law. So that's a big deal to me, because they say that the next biggest economic downturn is going to be because of student loan debt. Because my generation, we can't buy houses. We can't buy stock. We can't make investments because we have, I think the average student loan debt is $45,000. Well, that's just going to increase over the years because school is just getting more expensive. And we're told that we have to go to college. We have to go to grad school. We have to do these things out of a career. And really, it's just to our detriment because we can't afford life because we have the student loan debt, and that's really detrimental. And again, I like to tell people, like, we fell victim to predatory loans. The same way that the housing market crashed, the next crash is going to be because of student loans. And neither party wanted to address it for people that are already in that debt. And millennials are getting hit. I've talked about it in a lot of shows, that all the data shows that millennials are actually getting paid way less than our parents. And just last night, I was told that I'm entitled and lazy and all this kind of stuff, when actually the data just shows that we just want to get paid the same amount as our parents did for doing the same job. And that's not the reality. So on top of the fact that we're getting paid lower wages, we also have this large amount of debt. that will be weighing on us for me for the next 25 years, because they haven't repealed that forgiveness yet, thank goodness. But 25 years, I'm going to be, how old am I going to be? I'm going to be in my 50s, still paying off my student loan debt. Like, that's silly. That's so silly. It doesn't make any sense. And you look at other developed countries, and you get to go to school for free or a small fraction of the price. You should want your population educated, but we know, and again, I was just having this conversation, I've said it over and over again, that this is how totalitarian nations work. They want their people to be separated and uneducated, because then they're controlled very easily. And so they make higher education a villain, or they make it really expensive. So those are really important facts. So in the end, let's see, I got about 15 minutes and I haven't even gotten to my analysis yet. This was a very, very, very hefty topic to take on. And even, I still don't understand half of it. I'm trying really hard to understand it. But it's a very difficult thing. So in the end, like I said, as a business owner, I have noted that there's a large benefit for C Corps. And we've seen that with the tax reductions and also the new definition of a small business. Like I said, they're going to be paying 20% taxes. And they also lifted the tax floor for profit from $100,000 to $250,000. Again, that only affects large companies, and it should be really interesting how that plays out, because it's really detrimental to small companies. This tax bill is completely unsupportive of small companies, because most small companies are LLCs, they are S Corps, they are pass-through agencies. S Corps do have shareholders, which some of the definitions were changed, but in the end, this is in support of large business. Again, not shocking. I don't think that's shocking to anyone. I just saw today the president's approval ratings at an all-time low. Again, not shocking, but he's still there. So the actual Department of the Treasury. So this is, I should say, actually, that a lot of this information was directly from the Senate bill. And then when I was talking about the differences, it was from the Tax Foundation, and that was published on December 2nd. I always like to cite my sources. I don't just find this information out of nothing. So when I was talking about all the differences between the House and the Senate versions of the bill, that was from the Tax Foundation. And again, that was published on the 2nd of December. And currently the bills are in committee. So I haven't seen any newer analysis than that. So it should be interesting. I'm not sure. I haven't seen that there's any committee reports yet either. So we don't really know, because so again, back to how this works is both the Senate and the House have to go into committee, and then they have to write out a report, and then both bodies have to agree out on that report and the ultimate legislation in order to make it a law. So I haven't seen any of that analysis yet, but it'll be interesting to see how that works out. So the Department of Treasury projected that this would add $1.23 trillion in debt. And the biggest rhetoric among the leadership was that this bill was going to pay for itself over 10 years. So the 1.23 trillion is over 10 years, which the tax bills basically cover 10 years. So it's obviously not going to pay for itself by using trickle-down economics and reducing tax rates to the wealthy. How could it possibly pay for itself? And the tax obligation of the lower income people might be more significant by percentage, but as a gross income for the country, it's not that significant. So in a lot of my shows, I've been talking about the microaggressions of the current legislation, of the current leadership. And the most important thing is, so they couldn't get their health care bill to go through. But they are injecting these terms. I've been talking about it on every show. They are injecting these little provisions into all these different legislations that affect uh, medical expenses, like reducing and then potentially getting rid of the out-of-pocket deduction by getting rid of the mandate for health insurance. This is a slow but sure dismantling of the ACA. And I wouldn't be shocked over time if, again, they start incorporating more of these things. And again, it'll be really interesting to see what the final law says if they can come to agreement. There's no guarantee they'll come to an agreement anytime soon. Government works at a snail's pace. So, and then after the new officers are sworn in after the first of the year, it'll be really interesting to see how those negotiations go. So, at face value, there are minor tax reductions for low and median income people, but over the years of the tax bill, so I think it's until 2025, the largest benefit is for top earners. Again, this isn't a shocking idea, but they're selling it to the low and middle class by saying, oh, you're going to save $1,000 this year. Hooray, $1,000. But really, in the end, the benefit, again, is for all the top earners. And I have to say that in trying to research this and trying to read the bills and trying to see some analysis back and forth, it's really hard to find unbiased information about these topics. And again, I referenced earlier about how I was looking at all the, the social media posts and the major media posts, and they always just, the headlines are always like, the House just, they did a strike through this. The Senate just voted to take away your ACA. All these really crazy headlines. And I'm not saying that they aren't important. I think they are important. I think that these are issues that need to be addressed. However, I really encourage people to do what you can to look for the facts. Again, I have to stress, this is not a law. These were two bills passed by the Senate and the House. And in order for it to be a law, they have to come to an agreement. And again, there's certain things that I've seen people post that I cannot actually find in either one of the bills. And so I think, again, this is very difficult. I wish that, in a perfect world, the tax law would be simple enough for all of us to understand. I don't think that that's in the near future. I think that was a lot of the campaign with the Republican Party saying that we're going to simplify it, we're going to make it better, we're going to change it, when actually they did exactly what I would predict is that they made it more convoluted and they made the major benefit to the wealthy, whether it's between the changes in the estate tax, the reduction in corporate taxes, or the overall reduction in income taxes for the wealthy. I think that these issues need to be addressed because this is going to affect people. I know there's a lot of distractions between, changing the capital in Israel and, potential war. And I'm not saying that those aren't issues that need to be addressed, but we're missing the things that day to day that they're going to affect us. These changes to tax law will greatly affect people, even if at face it looks, I think, like, so when I was talking about earlier, if you make $19,000 a year, which I think that's still above the poverty rate for an individual. I think it's like the poverty rate right now is $13,000 a year. You can live in California for that. So if you make $19,000 a year, you're basically only saving $400 between 2017 and 2018. Again, is that significant? No. But if you make $1 million a year, you're saving $48,000. So you can see the discrepancy. Like, those are huge discrepancies. Again, you can look at the percentages and say, well, it's relative based on the percent of income, but really the impact, life isn't just about numbers and percentage, it's about overall impact and what that's really going to do And it'll be really interesting to see what they do with the child tax credits, because I think that will really impact families. And, this effort to dismantle ACA, it'll be really interesting to see, and personally, the individual mandate to have insurance, I'm not sure that that's why people have insurance. I think that the reason people have insurance is because they are getting subsidies, and they're being helped out with their insurance. So I'm not sure that the mandate, because the fines were so low, it's like, what was it? I think they increased it. Maybe it's like $100 a year now for the fine. But when you're talking about me as an individual paying $450 a month, I don't think that the mandate was what was making people have insurance, but I think it's a really important provision because, again, they're taking very small issues and changing them so that eventually they can cut out some of the broader issues. And again, the insurance companies are not at all regulated. I talked about it in my last show. Big Pharma is not regulated. They have some of the largest lobbying groups. And if people are healthy, like genuinely healthy, if we don't cut, what I talked about in my last shows, we're trying to cut prevention programs by 75%. If those things happen, then people will stay sick, and the insurance companies and Big Pharma benefit because they make money off of people being sick. And again, the insurance companies are trying to predict based on these changes what's going to happen in 2018. So they, again, a 33% raise in health insurance, that is crazy. That's not even minor, and we've seen significant increases since the ACA went through, but, we live in I live in California, so the subsidies are good. I believe the state will continue to do what it can to support the subsidies, even if the Fed is not agreeing with them. Trump has threatened to cut off funding to California for all different things. But I don't think that that's possible because the California doesn't need the United States. The United States needs California. And so I don't really predict that that's going to occur. And it's actually against a lot of the government procurement for the president to say we're just going to defund California. That's not how procurement works. That's not how contracts work. That's not how funding works. So we actually can't do that. All the budgets are set through Congress, and they do the allocations. They set the budgets, and it has to go through a vote in order to change those budgets. So those are a lot of empty threats. And so, again, I just remind people, don't get caught up in the glitz and glam, the drama, the headlines, and start looking between the lines, because any time that these very brash commentary or I'm going to defund California, like that's just not how any of it works. I always think of that commercial. I think it's a Progressive commercial where, she's like, oh, I put all these pictures on my wall and then everyone can interact. And her friend says, this is not how it works. That's not how any of this works. So that's a really important fact, is just we have checks and balances in this country for a reason. I'm not saying our process is perfect, but also, in closing, I just want to say that this isn't a law. And we don't know what's going to happen. And we don't know when it's going to become a law, if it ever does. It might not. It might not ever be a law. It may not ever go through. And especially when we have the transition to the new people that were voted into office this last special election in a lot of states, we don't know what's going to happen. So don't stay up at night stressing about what the proposed changes are. Stay up at night, if you have to, looking at between the lines and what's really going on and what the intention really is. I think it's very clear. Big business, help the wealthy, get rid of universal health coverage, even though it potentially saves money. Get distracted by the fact that Republicans always preach that we're going to save money, we're going to decrease debt. Never happens. But look at those issues. Those are big issues. And again, just don't rely on the headlines. Think about it a little bit and share correct and honest information so that we can all be in this together and start understanding these very complicated issues. So again, you are watching the State of the Union with DG the 30-something, and I am at KPCA-LP, Petaluma, California, 103.3 FM, also online at kpca.fm. And you can email us at kpca@pca.tv or snail mail us at P.O. Box 2806, Petaluma, California, 94953. Thanks for joining.